Today we're going to be diving into Alibaba, as this week we got some news that China would be looking to increase their stimulus program. So far, China has been a slow-moving country when it comes to rolling out stimulus, and right now analysts are expecting that to continue. However, there is some interesting verbiage that we'll discuss in this video that could indicate more stimulus that needs to be priced in than investors originally are thinking. So in today's video, we will discuss this change in policy and the effects that it could have on Alibaba's business. If you enjoy this video, make sure to drop a like down below. I really appreciate all the support, as well as subscribe for more videos like this one. Before we jump into Alibaba, let's take a look at the YouTube portfolio. Right now, it's sitting at $58,803.60. It's down a little bit from its all-time highs of around $59,000. And currently, all of our positions are in the green. Our lowest performing position is actually Google, which has been our most recent ad. It is up only 12.5%. We also own Alibaba, Apple, Microsoft, Palantir, PayPal, SoFi, and Visa. Our top three performing positions are Palantir up 700%, Apple up 400%, and Microsoft up 300%. On top of those positions, we have a couple of dividend ETFs. We have SCHD as well as VYM. SCHD is up 15%, while VYM is up 23%. I also have around $12,000 in cash. Right now, I've talked about selling out of one of these two ETFs in the near future, and I think that time period is getting very close. I'm considering the start of January as potentially being a good time to restructure some of my portfolio. In the YouTube portfolio, I hold a very small amount of shares of Alibaba, but in another portfolio, I have a more significant position. And one of the reasons that I've invested into Alibaba is because I personally like turnaround plays. When we look at Alibaba's stock price over the last 5 years, it is down almost 60%. And from its all-time highs in 2020, the stock has fallen over 70%. When I invest into turnaround plays, I'd really like to see a change in momentum of the stock within the next 6 months to a year. And for the case of Alibaba, I originally started building out my position and really built it fully out throughout the course of 2022. And from that time period till now, this stock has basically traded sideways. And I'm not certain that's going to change in 2025. There are a couple of factors that are going to play into whether Alibaba outperforms over the next 2 to 3 years or not. And those are Chinese stimulus and what the government is going to do around their policies between the US and China. Back in October of 2024, China cut their interest rates by around 25 basis points. However, this only had a very temporary effect on the stock price. It shot up to around $115. However, from there, it fell over the course of the next couple of months. And this has led to concerns from investors because they're concerned that China is not willing to do what they need to do to really turn their economy around. And this is despite China continuing talks around additional stimulus. Right now, a lot of analysts believe that China is not willing to do what it takes. They believe that China needs a bazooka style of stimulus to turn their economy around. However, this is not being priced into the stock. There's a lot of concerns that China is not willing to do that. They're not willing to roll out the stimulus necessary to improve their economy. However, there is some key phrasing that has changed from China that could indicate that more stimulus is on the way than investors are really anticipating. And this is the phrase that China is going to shift their monetary policy from prudent to moderately loose. This phrase, moderately loose, has not been used in China since the Great Financial Crisis in 2008. In 2008, China rolled out a stimulus package that was worth $586 billion. At the time, this was about 13% of China's GDP. And during this time, they also reduced the one-year lending rate by 156 basis points and cash reserves required for banks by 1.5%. The most recent stimulus package rolled out from China totaled around 10 trillion yuan, which is more than double that of 2008. However, this most recent package is for 5 years and it only makes up around 2.5% of China's annual GDP. Ultimately, what this tells me is that China has a lot more room to increase their stimulus into their economy. If they are only rolling out a package that's around 2.5% compared to 2008 where they rolled out 13%, they could increase this stimulus by 2, 3, 4, even 5x before they get back to the level that they rolled out in 2008. Obviously, an economy doesn't want to be propped up by a new stimulus package every 10 to 15 years, but if it's really necessary, they could do this to really stimulate growth back in the economy. The problem for China and why they might not roll out these additional stimulus packages is because of the other things that they're trying to achieve on a global basis that are affected by their currency and their deficit. Right now, the stimulus is projected to increase their fiscal deficit by around 1.4% next year. And if China cuts their interest rates too quickly, that could cause a sharp decline in their currency, the yuan. And those are two things that China does not want to happen. They don't want to see their deficit increasing as well as their currency being devalued, because they are one of the founding members of BRICS, which is Brazil, Russia, India, China, and South Africa. All these countries are looking to get away from their dependence on the US dollar. We're not going to dive into all of the political implications of BRICS, but if you just consider China, they are in a very tough spot, because if they look to reduce their interest rates as well as rolling out a number of additional stimulus, that will strengthen their economy, but it could devalue their currency. If China does nothing, however, then they won't strengthen their economy and they'll look weak overall. And that's one of the reasons why the US dollar has been the reserve currency of the world, is because the US economy is so strong. So it's hard to think that BRICS will have a lot of backing if the economies of these countries are not also strong. When we talk about Alibaba, they want to see a strong Chinese economy. A lot of their e-commerce revenue is coming from the country. It peaked in 2022. However, it's dropped over the last couple of years as they have had a number of issues throughout the country. However, international e-commerce has continued to grow over this time period. So from Alibaba's perspective, they would definitely like to see stimulus coming into the country. They want to get back to levels that they saw in 2022 or even 2021 in terms of revenue. Right now, what China is seeing is a lot of people throughout the country have not been confident in where it is headed in terms of its economy, and that has led to a reduction in spending that has hurt a lot of companies throughout the country. Despite a weak economy in China, Alibaba is still focused on growing a lot of the same areas that US tech companies are. They're focused on how they can implement artificial intelligence into their platforms, as well as expanding the reach of their cloud division. They actually look to cut prices for international customers, and this could be huge for Alibaba moving forward, especially if China and India are developing a closer relationship through BRICS. This could be big for Alibaba, as they could look to expand their e-commerce into India as well as their cloud into India. Right now, Alibaba is the number 4 player in cloud behind Amazon, Microsoft, and Google. However, these 3 players are not really able to compete in China. So what that means is Alibaba's only real other competition is Tencent, with about half the market cap in cloud of Alibaba. Another big advantage for Alibaba and Tencent is they don't have to spend very much on R&D, because ultimately what a lot of these Chinese companies end up doing is just copying the number 1 players in the US. And what that allows them to do is spend far less and just really implement what works within the US within China. China does lag a little bit behind in terms of adoption of technology. That does hurt these two companies, as well as some of the additional restrictions that we're seeing from the US on what types of chips are being sent to China. Those are going to have huge negative effects on these two companies. However, they have a very restricted market that a lot of these larger players really can't get into, and that allows them to really just compete internally. If you're a value investor, Alibaba and Chinese companies really have to be something that you look very close at. Right now, the forward P ratio for Alibaba is sitting at 9.08. Right now, the S&P 500 is trading around a 22 to 23 forward P ratio. So Alibaba is currently being valued at about half that of US companies. Analysts do have the company's earnings growing over the next couple of years. In 2024, they put up $8.55. In 2025, analysts are projecting $8.77. And then in 2026, that growing to $9.69. In my opinion, there are two major reasons why this this stock is not much higher. The first is the issues between the US and China. There are still question marks around what Trump is going to do when he comes into office. Is he going to take a hard approach against China? Is China going to yield to this? Are they going to push back? What's going to happen with a lot of those things? And then there's also the question mark of what's going to happen with the Chinese economy. I think if we see one of those two things turn around, we could see a bump up in the stock price. It could start getting back to this $120, $115 mark, and it might actually start holding there. But for the stock to move up much higher, I think we need to see these two things get corrected. We need to see better economics out of China, as well as a better relationship between the US and China. And clearly, because I'm invested in this company, I think at least one of those two things is bound to happen at some point in the future. But don't buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. With all that said, I hope you did enjoy the video. Drop a like down below if you did, and make sure to subscribe for more videos like this one. And as always, have a wonderful rest of your day. And for the joke of the day, why don't they drink water at the North Pole? Check the comments down below for the answer. Thanks for watching.